Hey, good morning, everyone. Marty Missouri here. It is Wednesday, the 11th of January, 2023, with your midweek stock market snapshot. Readers of the blog, this will have to serve as or be in lieu of the morning written note as well today, given my schedule. I'll jump right in, starting with the S&P 500 60-minute, 60-day chart. As I've been pointing out here, folks, this has been a bullish short-term setup. Remember, we had this consolidation area that we rectangled here last time we did this. I think it was last Friday. Real notable bullish divergences on our momentum indicators here. So all indications were that we'd break out to the upside. We have broken out to the upside. And now, as markets tend to do, we come back and tested the top of this consolidation range and have bounced off of that. You can see the gap here this morning. The S&P is up 61 bips as I speak at you here today. So pretty basic technical setup, very compelling to the upside. And that's how it's played out here on the hourly chart. Pretty good looking setup on the daily chart as well. There's that consolidation area that we pointed out last time, breaking out above that. Buy signal is developing more so than last time we looked at it on the MACD. Pretty good bullish divergence here on the RSI as well. So yeah, even on the daily, pretty good setup. Now, one thing that's very interesting here to me, because you know, folks, that we have ultimately a pretty bearish view of the market. And we think that bearish scenario plays out the first half of the year, but we've got to take the technicals for what they are. Couple things here. We have closed above the 50-day moving average. We did that yesterday, and you can see the gap up here today. And here is what looks to me like a very classic reverse head and shoulders. Okay, so imagine someone standing on their head, this being the head, this being the left shoulder right here, and this being the development of the right shoulder. Now, head and shoulders patterns have pretty good odds of playing out, and this one looks pretty compelling. Okay, so when it's a regular head and shoulders pattern, when you have somebody standing on their feet, right? You have a head, you have a shoulder, crooked lines here. This tends to be a topping pattern, right? So you basically come through here, you consolidate a little bit, you ramp up, and then you meet resistance. You fall back, you consolidate on the way down, and then ultimately you end up sliding significantly lower. Typically would be the way it plays out. And you have this neckline, and you tend to come down out of that, and then you come up, that finds resistance once or twice before it typically breaks down in kind of your classic pattern and how it's supposed to play out. Reverse head and shoulders work the same way, only in the opposite. Again, you have your left shoulder here, you have your head, you have your right shoulder, right? And your neckline is the bear market trend line, right? So this, folks, got to tell you, this looks pretty compelling. So what we're looking at here is potentially a failed reverse head and shoulders if we're right on our fundamental view. And we could definitely go through and breach this trend line. Until we get up here significantly, we're still in our bear market trend for certain. But again, I have to acknowledge that this is a pretty compelling setup. Now, to kind of walk that back a little bit, let's take a look at on-balance volume. Remember, on-balance volume basically captures the amount of volume total in a day in the direction of the move for the day. So notice back here this year where we had, for example, we had this consolidation area right here, but we had on-balance volume falling. So what that means is when the market was down, you got more conviction, you got higher volume versus when the market was up. And then you can see right here, you can see on-balance volume rolling over, right, as the market was once again going up to this bear market trend line. And sure enough, it rolled over. Here we were here as well. We had the market bottoming in October. We had that really nice October-November rally. but we had it again against a falling on-balance volume indicator, right? Again, more conviction on the down days. And then we came back up and we tested that level. That was pretty much right on that dot there. So we had a double top, but a real notable bearish divergence in the on-balance volume. So folks, despite what I showed you as, our initial screen setup, the consolidation with the bullish divergences, and this reverse head and shoulders pattern, which looks very clear to me, we do have a situation that still looks like distribution. It still looks like, we'll do air quotes, the smart money is using the rallies to divest of the stock market. Okay, so the unbalanced volume indicator, I should note though, is anything but perfect, right? If you just had, let's say, a day that's up all day on really good volume, and then right in the last 10 minutes of trading, the market dipped and it was 1 point into the red. All that volume that was upside volume, and let's say that last 10 minutes was on low volume, all that volume that was upside volume is going to get captured on this chart as downside volume because the market closed down a point that day. So that's why any one day you want to just kind of note it, but not put too much weight on it. But these trends you do, I could take you way back and you'd see over and over again, right? Here you had a higher high, but you had a descending unbalanced volume, and then you had quite the sell-off, right? Here, you had a reason to be a little bit bullish, right? You had a lower low, but you had basically a divergence, what would be a bullish divergence, because you didn't go lower on the on-balance volume. And then, so then you had a nice pop right in here. So that's definitely a red flag from a longer term perspective. Shorter term, again, on the hourly and on the daily, you've got these looks that are pretty compellingly bullish. Now, under the surface, doesn't take rocket science to figure out what's going on here. Clearly, we're still living in a bad news is good news world. Yesterday, or day before yesterday, the market really traded down at the end of the day, anticipating that Chairman Powell, yesterday speaking in Europe, would have the opportunity to talk down what has been a rallying market off and on lately, like other Fed governors have actively been doing. So clearly the market continues to rally on weak data / weak inflation or slowing inflation. Tomorrow morning we get the CPI number. Clearly the market is anticipating a weak number tomorrow. And it may very well be right. Looking across the soft data, the surveys, both manufacturing and services, and you're certainly seeing hints of inflation rolling over. And we're seeing that for the most part in the commodity space as well, softening to the point that the market will like it. As I intimated in yesterday's blog, however, titled Careful What You Ask For, our base case thesis is that the economy is going to end up in recession, likely the first half of this year, and that corporate earnings estimates, while they're being ratcheted down, do not yet reflect where they're ultimately probably going to go, where earnings are going to be in a recessionary environment. And that typically is your next leg down in a bear market. The first leg in this type of bear market is interest rates rising. Suddenly there's an alternative to stocks. Valuations need to be discounted. And so there is where we came up with our 3,500 on the S&P 500 bear market target early last year. But the conditions were that we did not have a recession, that we figured that 3,500 made a lot of sense as inflation picks up, as interest rates pick up, and as stocks get revalued. Ironically, that's exactly where the bear market bottomed so far. So that sounded pretty smart, but the problem was that caveat that we said that's conditional on no recession. Now our PWA index is in the -30s, which says recession is on the horizon. But we do think it's going to be a mild recession, and we think we're going to come out of it pretty strongly in the areas that we are, accumulating positions in. And we also, by the way, think that with the mild recession and as we come back, inflation is going to come back quite quickly. And that ultimately we're going to live with a higher inflation regime. not 2% or below, probably more like 3 to 5% over the long term. Makes sense based on the structural pressures that we've talked about a lot on the blog these last couple of years. And we think people will settle into that. And the Fed will settle into that as well. Whether they raise their target or not, they adamantly seem to stick to this, in my view, this ridiculous notion that they have to stick to a 2% inflation target. So be it, but they won't be able to manage to that without creating serious economic problems in this new regime / environment that we're in currently. So in a nutshell, market is liking what it's seeing in the macro here of late in terms of slowing in the economy, inflation coming off the boil. So folks, we're still in this very tentative trading environment, if you will. I've just showed you what it looks like on the on-balance volume, showed you some technical indicators, one a little more potentially durable than just the short-term 60-minute chart look, and that's that reverse head and shoulders. That's going to be very interesting to see how that shapes up in the weeks to come. So I guess I'll just leave it there. That was a lot of rambling. Thank you for hanging in there with it this morning, and I'll be back tomorrow morning with a written note, and then Friday or Saturday with another update for you. Thank you, as always, for watching and listening. Talk to you soon. Bye-bye.